Okay, before we jump in, some updates on the applied series. And I don't know if anybody was watching the Q&A from last week. One of the questions was, how long do I plan on continuing on with the applied series? Because right now I'm just adding videos sort of on a weekly or bi-weekly basis. I just keep adding them. And I think the question was also in lines of how long do I plan on continuing with the market outlook. I have no plans at this point to stop, and in that video I said, I don't know, 10-15 years at this point. I don't know if everything will be done in the same form, but I don't plan on leaving this industry for a long time. I plan on being here for quite some time because I don't think my job here is done. For the market outlook, I don't know if it'll stay in its existing form for the next 10 or 15 years, but as of right now, I have no plans to change it from its current form on YouTube weekly for free. I have no plans of changing that. In the applied series, I have no plans on ending that anytime soon because I'm not done what it is I want to do. So hopefully that helps you out. There in the futures folder, in case you were unaware, bond futures has been up for about the last week. It covers the 2-year, the 5-year, the 10-year, and the 30-year. If you're looking for the portfolio management series that I said that I would flip to, part 1 is already up. You have to go into the top-down folder. I didn't know where to put it, so I put it in the top-down folder because it really is top-down. I put it in the top-down folder, and it has its own folder within there called Portfolio Management. Part 1 is up, Part 2 is up this week, and Part 2 shows you how to salvage a loss. That if you, once it starts with the assumption that, okay, I want to take this loss, I'm done with this. It then says, okay, well, hang on now, before you do it, can we do better? Is there something we can do to salvage this loss? And it works on the assumption that if you have a $5,000 loss and you want to bring it to zero, it is the same as going from $0 to $5,000 in another stock. It's the same thing. In terms of your return, it's the same thing. But I show you that this requires less capital than this, that you need less capital than you would over here. And not only that, it's not enough to say, let's take it from 5,000 to 0. It must beat a benchmark. So it can't be that, well, you took 10 years to recover it. Well, that doesn't make any sense. It must beat a benchmark, and our benchmark is going to be the 3-month rate plus 400 basis points. Why? That's very close to a high yield at this point. So we've got to get at least a 9% annualized return. Otherwise, it's not doing. It's not worth doing. So imagine that you could go back over the last, well, let's say 3 years. Take your 5 worst losses and reduce them by 90%. That is what Part 1 will do for you. It'll show you how to avoid having had these 5 worst losses. Take all of your other losses and reduce them a minimum of 20%. Now, if you did that, where would you be? That is what Part 2 is designed to do, is show you how to minimize your loss. You decide that you want to take a loss. Okay, why not try this instead? Do this. And I will show you how you can reduce your loss by at least 20% while at the same time beating this benchmark, 900 basis or 9%. So if it takes 30 days to do that on an annualized basis, we have to beat this. And I give you one example of a stock using Alcoa, how we can use a very, very conservative approach that significantly reduces our capital and has a 15% return on invested capital for the strategy using a 55-day option, a 15% return on invested capital annualized. Which reduces the loss by a minimum of 20%. In many cases, you can recover almost 100% of your loss. If you followed the rules in Part 1 and you get to Part 2, you can find that you can recover most of your losses. And again, with less capital. These are the same things. I want you to understand these are identities with less capital and beating a benchmark at the same time. So that is part 2. I have used that. I use this strategy a lot. If you do have the applied series in the option series, I show you using ChargePoint. I used it specifically. I sold puts on ChargePoint specifically to get into trouble because I knew they'd be put to me. In a rational world, I never would have done that if I were doing it for myself, but I needed to do it to show you how to get out of trouble. And I think within 3 months or 4 months, it ended up being a very profitable trade just by working the options and working our risk exposure. Also for the applied series, live Q&A sessions are coming. They're coming monthly because the subscriber count has passed a key threshold. I'm not going to tell you what the threshold is because I have competitors who watch me. But in terms of the number of subscribers, I've passed a key threshold. And whenever you pass certain thresholds, you have to add more value. And this is a good lesson if you ever want to build a business, is there is some core service that you have to provide. Get that core service out. In designing your business, you could probably start thinking, oh, but we can do this, and we could do this, and we could do this, and we could do this, and this, and this, and this, and we could do all of these things. So you keep trying to perfect your business until you have everything ready to go. That's the wrong thing to do. Introduce your core. The big reason why people want you is the core. Once the core is satisfied, this is if you think about it this way here, like this is called the long tail. Right? And that's called the long tail. Introduce the core. Once the core is successful, you start introducing the tail. You start bringing that in. Well, that's what this is. So there'll be some live Q&A sessions monthly. I'll probably use Vimeo for that, which means I'm live. I'll have my black screen and you'll hear me speak. You type in your questions and I answer your questions. And this is all related to the applied series. We'll start monthly. If those sessions are well attended, in other words, they're crowded, because you get 200 people on a session. That's almost unmanageable with the sheer number of questions that come through. Then I'll go to bi-weekly on that one. And if that still is unmanageable, I'll go to weekly. This is all part of adding the tail. The core is proving to be successful enough that I can start adding the tail. Also, for this week for the applied series, under Market Outlook, under Extras, I do talk about what Home Depot and what Walmart said in terms of their guidance, because I think it's important. This week we have a bunch of retail coming up, and the guidance is going to be important. Home Depot dropped like 7% on its report. Walmart, a lot of volatility on the day, and then it drifted down after that. Office REITs, things going on there. This is a sector in the REIT space that I think we just want to avoid for a while. And in metals, BHP, Rio, FCX, etc. We'll talk about this in relation to China and in relation to the US dollar and what I'm doing with these guys. That is for applied series subscribers. Okay, this part 2, just so that you know, don't rush there now. This part 2 will be up on Monday. Okay, it is narrated and done, but IT doesn't work on weekends, so there's not much I can do anymore. That'll be up on Monday. Same with the extras. That'll be posted Monday as well. Okay, let's head in for the week. Well, we've got a lot to cover this week. I'm going to spend some time on the PCE because it was a little bit more damaging than what we thought. And then I've got some artwork for you to see to tell a story. And part of the story will be the 3-month to 10-year curve and what's going on there. Let's look at our rates over the course of the week. Money market rates from the 2-month all the way to the 1 year, all hitting new highs for the cycle. And I've circled the 2-year because the last cycle high was November 7th. We have now taken out the November 7th high. The 2-year ended Friday at 4.78, which is the new cycle high. I think the rate before that was 4.75, only 3 basis points, but still, there we are. Have a look at the 10-year. The cycle high was 4.25. We're sitting at 3.95, 30 basis points below. And I'm not sure what happened here on my spreadsheet, but those should have turned green. These are correct in being red. The 10-year is an interesting story here because it is the bond market finally getting on side with the Federal Reserve. You'll recall on February 1st, the Fed raised the overnight rate 25 basis points. And in response, the market cut rates on the 10-year, I think by 17 basis points on that day alone. It was just a big increase in price on the 10-year, a big drop in yields, to the point where the market had cut rates on the 10-year by 50 basis points since the beginning of the year. The exact opposite thing the Fed had wanted. Well, now it's given back those 50 and actually raised rates on the 10-year by 7 basis points since the beginning of the year. So we're heading in the right direction there. Bond market is getting it. The equity market is getting it. The credit market, couldn't be interested. FOMC meeting, 24 days away. And before that, they're going to get another CPI report, which is 16 days away. That's on March 14th. We'll see another CPI. Jobs is March 10th. Usually we get it the first Friday of every month, but this time around we're getting it on the second Friday, March 10th. I didn't ask too many questions online to figure out, well, why is it the 10th? I just said, okay, well, it's the 10th. It's in 12 days. Curve inversions, the 2 to the 10, 83 basis points. That's 235 days now. That's just a capital market inversion because the 10-year and the 2-year are both capital market rates. I think the longest was over 500 days. So yeah, it can stay inverted for quite some time. The 3-month to the 10-year, that is a capital market to money market inversion, much more significant in terms of how it changes behavior. And it's beginning to uninvert, but it's not uninverting by the 3-month dropping, it's uninverting by the 10-year increasing, which is a fairly dangerous phase of the curve inversion because it will change behaviors in a negative way for the real economy. And I'll explain that when we get to my fine artwork that is coming up. You're going to love the artwork. Negative 91 basis points, 123 days now. It's important to point out this has a 100% track record. This does not have a 100% track record. We got some Fed speak next week, Monday Jefferson, Thursday Waller, Friday. You've got 3 in a row, the triple Bs, Bostic, Bowman, Barkin. Fed balance sheet down $3.2 billion, still continuing on. They are signaling no intention of slowing this down or stopping this. This is all MBS, sitting at $7.886 trillion now. And again, as I pointed out, this is not the full Fed balance sheet. This is just the open market operation assets they bought for quantitative easing. That's what they're letting run off. Every business needs assets on their balance sheet. The Fed has a balance sheet. Even if they didn't do any of this, the Fed would still have a balance sheet of about probably 500 to 600 billion. This is not the full balance sheet. This is just the SOMA. The forward curve here is rising as well. The 3-month rate 18 months from now minus the current 3-month rate inverted 75 basis points. Last week was 100 basis points. The effective Fed funds rate 4.58. Reverse repo in demand here. Let me write out the February 24th from 2.059 trillion to 2.142 trillion, an increase of 82 billion. Money market funds hang out primarily in the 1 to 3 month. Sometimes they go a little bit further, but primarily the lion's share of that money is in the 1 to the 3 month. There just simply aren't enough securities available, and with rates this high, there's more money flowing in to money market funds than before, and there just aren't the securities, so they have to go somewhere. So we see where they're headed here. 4.55%, which is equivalent to a 1-day SOFR. This is money flowing out of the Fed. So this is going to, at some point, become a bit of an issue, if it isn't already an issue now. But it's just not showing any signs of dropping below that $2 trillion mark. and I don't think it will, as long as you have, you get almost 5% on the short end here, 5.02 on the 4-month, 506, 505, 6-month to 1 year. We'll compare these, the 6-month and the 1 year, with where high yield is, and this is 6-month. That is a government security, risk default, risk free. So we'll compare that with a AA security, which has some credit risk, and this is really odd. The 6-month and the 1 year both have a higher yield as a risk-free security than a AA security, which has some credit risk. So the idea that credit is mispricing things can't be more obvious, I think. Look at our probabilities here for March. For 25 basis points, it's dropped to 73. Last week was 81.9. The week before was like 91. Dropped to 81, dropped to 73. And the 50 basis points is now at 27. It was 18. A couple weeks ago, it was almost 0. And June 14th, 5% here. Last week had a 2.7% probability. It's got 0%, and a 6 has shown up. Last week it had 0% probability. It's showing up, 0.9. Not much, 1%, but still it's now on the board. It's something that you see. It's something that your eyes can look at and say, 6%. That's going to start to get normalized, right? All rates have increased, or the probabilities have all increased to higher rates. 5.5% at 56.8. The 5.75 went from 10% to 20.5%. 5.5, that is suggesting that you have 3 25s in a row. You know, the question is, are they going to do 50 basis points in March? I think they're going to avoid that, because that's going to be a credibility hit, because they've invested a lot in the last 2 meetings and in the minutes in talking about the cumulative effect of rate hikes to this point, and of slowing down the pace of rate hikes, to suddenly shift into a higher gear, going 75, 75, 75, then to 50, then to 25, and then to go back to 50 is really Arthur Burns-ish. So I think they're going to stick with their 25. I think they're happy that the capital market rates are actually doing some of the heavy lifting for them and not fighting them anymore. I think they're happy about that. But I think they're going to have to stick with 25 unless the CPI in 16 days gives them no choice. In other words, it's so hot that they really have no choice but to go 50. I think they'll go 25 and signal that, listen, we'll do 25 for the next 5 meetings, the next 6 meetings. And we also get a dot plot. So maybe they'll signal their intention in the dot plot. Not so much an intention, but signal to the market what the market should start to believe, so that the market can start to price that into the curve, as opposed to them actually having to do it. But I think cycling back up to 50 at this point, after they were slow to get into the game, and had repeatedly said, you know, the history warns us to have slowed down to 25 and then suddenly have to jump up to 50. That press conference is going to get ugly. With, well, you know, this is a repeat of what Arthur Burns did. Are you not? You know, you said you were learning from history. Clearly, you're not. It would be a big hit to credibility. I think they're hoping that the jobs report that comes out is going to be more in line. And I think this comes out on the 10th, and I think there's another release on the 14th. Here it is, real earnings for February scheduled to be released on March 14th. So you'll get the employment situation on March 10th, and then real earnings on March 14th. But I'm thinking that they're almost locked in to 25 simply because of the rhetoric and the language that they've been using at this point, sitting at almost forcing them to sit at 25. Real rates from the 5-year out to the 30-year have all increased. And if we look at the 5-year to the 10-year, we have an inversion of 15 basis points. Increasing real rates are the real danger. to present values of future cash flows. Not so much nominal rates as I explained last week, because both the numerator and denominator with nominal rates have an inflation component. But when you take them out, all you're left with is real cash flows and real rates in the denominator. So when real rates go up, the present value automatically goes down. Mathematically, I shouldn't say automatically, but mathematically, and more so with REITs, because the cash flow for REITs is more bond-like, it's more coupon-like. So if we look at the IYR over the last week, didn't have a good week. You'll recall that I had sold calls, $88 calls on IYR for February that I rolled forward to March. Not only did I roll forward, I rolled down as well. So they paid off nicely. The REITs that I hold in my portfolio all dropped in value, I think, except two. Two of them actually went up last week, which was surprising, but they all dropped. But that drop was nicely offset to some degree by the gain on the calls that I sold on IYR, which is a nice risk management thing that you can do. Is if you have a segment of your portfolio that's holding stocks that have no particular options on them, and REITs oftentimes either don't have options, or if they do, they're kind of illiquid, because many of them have very low volatility, so it's not worth playing the options. That if you can find an ETF that has liquid options, you can use the options on the ETF to hedge against your portfolio. The break-even rates, not much of a story to tell there. Those aren't significant enough moves. The Fed Fund futures, this is interesting. Last week bottomed in August at 94,705, implying a rate of 5.295. That puts you in the target range of 5.25 to 5.5, but just within that range. Well, this is now August, September, October, all bottoming at 94,605. The rate 5.395 puts you squarely within the range of 5.25 to 5.5. So the market is now pricing in 3 consecutive rate hikes of 25 basis points. And we can see our higher for longer here, gone from 5.29 to 5.39. That's an increase of 10 basis points. So market is saying it's going to be higher. And going from August all the way out now to October, there is your longer. You'll recall 3 weeks ago, we were bottoming out in July and then raising from there. And then 3 weeks before that, it was May, June, July. So now we're all the way out to October on the low at 94,605. And December has gone from 94.87 down to 94.695. So the rate implied was 5.13, is now 5.305, which is in the same range as we are for August, September, October. Only a 9 basis point difference between where October ends and where December is. I have at 94.685 added to my ZQ position, my long position in ZQ. Let me be clear what I'm doing here. This is purely a call option on a recession. It's not because I think the Fed's going to cut rates this year on its own merits. It's because I think a recession is going to show up. Something is going to happen which will cause the market to anticipate a lot of Fed rate cuts, and this will start to rise. And when they do cut in response to a recession, because they'll have to, and listen, if they're trying to solve inflation, nothing solves inflation like a recession. Nothing solves it like a recession. Very quickly and very fast. In fact, you would almost argue that we can get through all of this very quickly if the Fed just raised rates 300 basis points at the next meeting and just said, look, let's just do it. Let's just get it out of the way, do it now, and by the fourth quarter, we'll all be okay. This will all be over, and we can move on. You could get that done if they did something like that. But don't do that if anyone from the Fed is listening, because if you did, you would hurt me over here. And I don't want to be hurt too much. I do expect this to print negative for me for a while until the recession shows up. Somebody asked me, well, why now? I mean, we're not in recession territory now. The economy doesn't look that way. Very rarely do we get endogenously led recessions, meaning that the economy goes into recession purely by the weight of its own inefficiency? It's usually some external event that happens, some unforecastable, unforeseen external event that does cause some harm. And when you're in a low growth environment, it takes you into a negative growth environment. Well, being that you don't know when one of these are going to occur, you kind of have to be positioned for it because it is random. And that's all this is waiting for a random event to occur. So don't read too much more into that other than me putting in a call option on some external event that will force the market to believe that the Fed is going to lower rates, or that will force the Fed actually to begin to lower rates because there's a bigger problem to deal with. The 1 year rate, 1 year from now, the forward 1 year rate, there's a better color. Mine's the current 1 year rate, inverted 54 basis points. I am using, for this one here, I am using a 2 year coupon to get it done. I should be using a 2 year spot, but being that the curve is fairly flat between, I say fairly flat between the 6 month, the 1 year, and the 2 year, there wouldn't really be that much difference. So it's a close enough proxy. 54 versus 80 basis points last week. So this is beginning to uninvert, but again, the wrong way. And because it's uninverting in the wrong way, it's going to have a significant impact on behaviors. So when we get to my artwork, which is coming up, I will explain that. Let's look at 2024 and what the market is doing there on the forward curve. December 23, December 24, looking at the 1 month forward curve on SOFR, 522 minus 384, 138 basis points lower. 2 weeks ago, it was 151. A week ago, 143. Now it's 138. So slowly, rate cuts in 2024 are being priced out of the forward curve. TLT. Let's look at that trade. Lots going on during the week. Look at this. All right, that's a lot of volatility. You were down, then you were up, and it looked like it was going to be an ugly day. Then it was a good day. Then it was an ugly day. It was quite a ride, but over the week, only down 0.51% overall. SPY was down 2.64%, and they still have a positive correlation between them. I do expect that correlation to turn negative. That is why I have short beta and I have long duration right now, because I do expect that to turn positive in a way that the market is going to drop and duration, our bonds are going to rise. So I'm positioned for that. Right now, because they have a positive correlation, the volatility in this pair is very, very low. Because I'm short beta, so the market drops, I win. However, bonds drop and I lose on duration. So they tend to offset each other. Implied volatility coming back in, 13-week, the percentile, the IVP, is 30% versus 21% the week before. So there is some money coming back into the options. So if you're looking at playing puts on this one, it's kind of coming back for you a little bit. For duration, the rest of my duration trade, ZB, which is the long bond futures contract for June, the June contract, I added the 124 puts. Well, added. I already have 124 puts. I added more on the 124 puts. Premium, almost 3 points, 2 and 53/64ths, because they are quoted in 64ths. These expire May 26th. I do expect that the long bond will probably hold its levels where it is. I think a lot of this has been priced in at this point based on what we saw last week, because of just the sheer move in the Fed funds futures. I think it's primarily priced in that the market went down almost 3% and TLT only dropped 0.51. Sort of tells me that as yields on the long bond move up, that you have a lot of funds that rush in and say, let's grab some of that now. Let's just lock in that yield. So I think that there is a floor to how low this price will go, or a ceiling to how high the yield will go. I'm comfortable with the 124s. And nice thing about the options is I can roll them forward indefinitely. And every time I roll them forward, I'll pick up a bit of premium. Every time I'll pick up a bit of premium. That adds to the 2 and 53 over 64. So if you take 124 minus, well, let's call it 3 so we don't have to worry about that. My put price would be 121. But every time I roll it forward, I might be picking up, 30 64ths or 30, or half a point, or depending on where it happens to sit. Sometimes I may be able to pick up a full point every time I roll it forward. So I'm good rolling those forward indefinitely. If you have the applied series in the portfolio management folder, I will be adding one whole video on rolling forward and what the benefit of rolling forward is, especially when you're short. Rolling forward when you're long can be a loser's game very quickly, but rolling over when you're short, you pick up premium each time you roll forward, so you can roll forward indefinitely. Yeah, so I have added to my ZB position the 124 puts. Now, here is how this kind of works out. Let's say that I'm right and bond prices move up. Well, I only get the premium. I have no upside to ZB because I'm not buying calls. I'm selling puts. However, remember, I am long. I'm now long 60 110 call options on TLT for January 2024. So if ZB moves up, if bond prices move up, I win over here, and it starts pushing up my call price over here because the underlying of TLT is ZB. Well, when I say the underlying of TLT is ZB, the underlying of ZB is the same as the underlying of TLT, which is the long bond. Looking at credit spreads, OAS, they have increased, but really, that's not a lot to talk about. On high yield, 6 basis points on high yield to 4.3, up off the 400 basis point level, now back at 4.3, so high yield is giving back. But triple C, just this is where you don't want to be, and hardly moving at all, 13 basis points. So this particular market is not really seeing any reason to be afraid of anything. 6-month yield 5.06, 1-month yield 5.05 from U.S. Treasuries. The 1 to 3 year investment grade bucket is at 5.48, so it's an extra 43 basis points going from a 1-year default risk-free to picking up investment grade. This is curious here. You got the AA bond here at 4.93, a yield to 4.93. And the 1-year default risk-free is 5.05. So you can take 5.05, or you can accept some credit risk and get lower and get 12 basis points less. It's like you want something that is default free, you can get 5.05. If you're willing to accept a little bit of credit risk, you can get something lower. Like, you stop and think, but why would I do that? Why would I ever take 12 basis points less for something that has just a little bit of credit risk when I can get 5.05 for none? I find that very odd. You see AAA at 4.7. U.S. Treasuries used to be AAA. Remember, they got downgraded a while back to AA, but they are AA. But really, I mean, if you think about it, they're backed by the government. Sure, they're AA, but for all intents and purposes, they're really AAA. I don't know. These yields just to me seem rather odd that there'd be enough money rushing in to push these yields to 4.7 and 4.93 when you got 5.06 and 5.05 in a much more liquid market. Anybody else find that curious? Speak up. Mortgage rates climbing back up 6.5 on the 30-year fixed rate mortgage, and this is as of the 23rd, not the 24th. So you got to look at the 10-year Thursday over Thursday, not Friday over Friday. It was up 2 basis points. The fixed rate mortgage is up 18 basis points, so the spread is increased by 16 basis points. That's negative for mortgage REITs in terms of their valuation. In valuation, but not negative in terms of their net interest income and their dollar rolls. So any pullback on mortgage REITs, I think, represents a great opportunity to step in. You go to Mortgage News Daily, they'll give you a Friday rate. They have 6.88 versus 6.5, suggesting I think it was like up 8 basis points day over day. So they were at 6.8 the day before when Freddie was at 6.5. So you could say, well, this might be up to 6.6 by Friday. Mortgage apps, we can really see the higher mortgage rates having an effect here, down 13.3%. Refi is down 2.2, but look at the purchase index, down 18.09. We're also seeing home builders give back during the course of the week. DHI was over 100, found its way all the way down to 90. So I sold 89 puts. I sold 87 puts as it was dropping. And I was looking, just laddering down by $2 each time, looking for the 85 puts, but it's kind of holding above the 90. But if it breaks down under 90 and the 85s give me good premium, I'll sell the 85s on that one. Existing home sales down 0.7 in January. New home sales up 7.2. Monday we're going to get pending home sales, and Tuesday the Case-Shiller Home Pricing Index. We haven't visited Realtor.com in quite some time, so I just popped over there to have a look at its week over week. Time on the market, this is, remember they do it weekly, right? The week ending February 18th versus the week ending February 18th year over year, 24 days slower. Recall when we used to look at this thing, we'd be looking at 6 days slower, 7 days slower, 8 days slower. We're now 24 days slower year over year for selling a house. So the house is staying on the market about 3.5 weeks longer than it was last year. So the housing market, is clearly in recession, but we have a shortage of housing. It is even worse in Canada. The projections for Ontario alone, our government wants to let in 3 to 3.5 million immigrants, new immigrants to the country by 2025. So that really is 23, 24, 25 over the next 3 years. And they primarily land in 2 provinces, Ontario and BC. And there are other provinces as well. I don't think Manitoba gets anybody, to be honest with you. There's 3 people there and they're happy. Alberta gets quite a bit. Montreal or Quebec gets quite a bit, but Quebec seems to lately be saying, please no more. In fact, there's one crossing from the U.S. into Quebec where they're, saying, the Premier of Quebec is saying to the Prime Minister, hey, you got to shut this down. No more. So I don't know if Quebec is too welcoming at this point. But Ontario alone, the projection is 1 million to 1.5 million new houses or new residences are going to be needed over the next 3 years to handle this. That simply just doesn't exist at all. So as a property owner in that province, in the Golden Horseshoe region, the Golden Horseshoe is Toronto, they call it to Hamilton, but it does extend to Niagara now. That's why they call it a horseshoe, because this is Lake Ontario here. And Toronto's above the lake. St. Catharines, Niagara is below the lake. They call that the Golden Horseshoe. Being just on the cusp of the Golden Horseshoe makes me happy. It's like, okay, well, that's good. But this is interesting, 24 days. However, the home builders, DHI and Lennar, are the 2 biggest ones in the U.S. And if you're going to be in home builders, I think any one of those 2 are the interesting ones to be in. And as the spread gets wider, mortgage REITs will drop back, but I'm interested in mortgage REITs, primarily agency. Is a fairly solid one. Annaly is fairly solid as well. NLY. I think it has a higher yield than agency does, but it's quarterly. It pays quarterly, whereas this one pays monthly. So I'm not sure if you consider the compounding of the monthly dividend, if you're reinvesting, to be on par or equivalent with the quarterly dividend. I haven't done the conversion of the yield, so I'll leave that to you to do. Okay, a couple of screens on PCE. We'll look at some headline tables from this report, and then we'll compare the revisions that we saw this month with what the original numbers were that we had seen previously. And we'll see that not only did we have numbers this month that weren't friendly to the market, but the revisions were pretty much all unfriendly as well. That had those numbers come out then, you probably wouldn't have had the January that you had. For personal income, this is you had an increase in January 0.6 month over month. For disposable personal income, it was quite significant too, really out of line with what we've seen here. As Social Security, if you go to the more detailed table which itemizes the sources of income, you'll see the line item for Social Security under January is up a lot, and that's because of the cost of living adjustment within Social Security. January, it resets significantly higher, which is a good thing for the recipients of Social Security, right? Not so much a great thing for the Social Security fund, which is already got a lot of questions being thrown at it as to how long it can last. If we look at services X housing, here are our price indexes over here. We have 0.6 on PCE, and excluding food and energy is 0.6, and this breaks down into both goods and services. Services X housing was up 0.58, so if you annualize it, that's 7.2%. This is where they're looking. That's the number that they're looking at. Although I don't know that they do a 1 month annualized, but if you take the 1 month annualized, it's 0.72. That 0.58 is not going to be friendly to them. These are within each month here. You're looking at revised numbers, and we'll see what they had previously been. We had gotten retail sales previously, and retail sales is reported in nominal dollars, and I made the case that you cannot deflate retail sales with either CPI or PCE, no matter how you cut it, or remeasure CPI, no matter what categories you leave out and what you include, even if you try to match it up as closely as possible to the categories of retail sales. You still can't do it. It can't be done. If we want to know the difference in quantity, we have to look at real PCE. In January is up 1.1%. Goods up 2.2%. Services up 0.6%. This is measuring the increase in quantity by removing price. You cannot do it with retail sales. You'll find this in Table 7. In Table 1, to find the weighting of services in PCE, because PCE is the C in GDP, right? It's consumption, personal consumption expenditures. You go to Table 1 and you'll take services divided by consumption, which is line 38 divided by line 34. You get 66.52%. And the weighting for shelter is roughly about 16.6, 16.5, sometimes as high as 18%, so that's where you get to roughly 50% of PCE is services X housing. And this is far more labor intensive than any other part of consumption, and that's what they're looking at over here. You're not going to solve this problem without solving the wage inflation problem, and you can't solve that without solving the labor force problem, and you're not going to solve that by getting more people in, because you have a structural, I think, shortage in the market. It's not just cyclical, it is a structural shortage. So the only way to do that, to introduce slack into the labor market, is force companies to get rid of labor. That's the only way you can do it. Here is change from preceding month for December. Just to give you some idea, we'll just ignore November for now. We'll just pay attention to December, and then we'll look at a table that looks at, I think I have 3 months, October, November, December. Look down here, personal consumption expenditures in current dollars and in chain dollars. So in current dollars, the belief was December month over month was down 41.6 billion. It was actually only down 23.2 billion in nominal dollars. So it's actually higher than what was previously thought in terms of nominal dollars. So the conclusion is, well, consumers spent more. If we control for inflation, if you put in chain dollars, it would have been negative 40.8, drops to negative 47.1. So they spent more on fewer items. That has to mean that the price index was higher than previously thought. And we see it here. The disposable personal income in current dollars was actually more, but in chain dollars it hadn't changed. And down here, personal consumption expenditures in current dollars was actually higher. However, in chained dollars, it was unchanged. So that percentage-wise, you spent more. However, controlled for inflation, no, you didn't. So the combination of spending more without any change in quantity or for fewer items, as we see here, means that the previous number that was reported as it came out understated what inflation was. So had the real number come out, had the newer number, the adjusted number come out, then I really don't think that you would have had the January that you had, and I think that the Fed action probably would have been different for February. I don't think they would have downshifted to 25. I think they would have stayed at 50. Let's have a look at 3 months of revisions on the next screen. Okay, so this is October as reported, and this is what we just saw on Friday. This is the revised October. This is November as reported. Here is the revised. This is December as reported. Here is the revised, and I've cut all of these little parts of tables and put them together in one table. That's why it all looks awkward here, because these are all different columns I cut and put in place. So here is durable goods across here. Negative 0.6 was reported in October. No, it was only negative 0.4. In November, negative 0.8. No, it was only negative 0.6. December, negative 0.3. No, it was only negative 0.2. So I put a plus sign everywhere where the number as reported versus revised was higher in the revised, where the inflation reading was higher. Look at all the plus signs. Look at all the plus signs. Only one negative sign, which is energy, goods, and services, up 2.5% in October. As reported, was revised to 2.3, down 0.2. But every other number I put plus signs beside. Look at all those plus signs. So the numbers that were as reported were all revised higher. Had the revised series been reported at the time, while it was moving in the right direction, was nowhere near the extent that the as reported number showed. The rally in January would have been much more tempered. The central bank would have been, I think, less willing, especially Powell, less willing to say things are very promising, the disinflation process has begun. I think that language probably would have changed, and I think they would have gone 50 in February. But now that they've downshifted to 25, I really don't think, for their own credibility, that they can upshift to 50 at this point. I think they have to stick with the narrative that they've already put out, the cumulative effect of all the rates so far, and it's not a question of how fast, but how high. And I think they'll signal that, we've got a lot of work to do, and they move 25, and they're going to signal that they're not even talking about when to downshift to zero, that the pause isn't a conversation. They're going to have to signal that. And I think that from here on in, the best thing for the central bank is to have Powell come out, read from a statement, and leave. Stop this press conference, because I'll tell you, that is not his strong suit. But just let your eyes sink in on all those plus signs. Okay, pictorially, this is where the economy is right now. And I've tried to draw it out as well as I can. You're looking at good art when it is open to interpretation. So we can see that we have a cargo ship here. But what we don't know is what it's carrying. Is it wheat? Is it steel? Is it iron ore? There's the interpretation, right? So you're looking at good art when it leaves something to you to interpret, where you bring some meaning to it. So imagine that you have a cargo ship going down a narrow channel. That's your soft landing. And you have to navigate down that channel. You get too close to one shore, which is expansion, inflation is going to show up. If you get too close to the other shore, you tip the economy into recession. And you have to do this while steering backwards. You can only look backwards, because when you get data, the jobs report, inflation numbers, these are all backward looking. So you have to steer this ship down that narrow channel without hitting any of the shores by only looking backwards all the time. Exogenous events occur. I shouldn't say all the time, but exogenous events occur at random, but they occur. You don't know when one's going to happen. You don't know where it's going to happen. That's what makes them exogenous events, is they're unpredictable. You don't know what's going to happen, but they do occur. And they do have an effect on economies. And an economy in a low growth environment that get hit by an exogenous shock tends to push it into the recession. So you've got to avoid these exogenous shocks. You've got to steer through a narrow channel, all the while looking backwards. You get too close to this shore, well, this is expansion. We saw January economic data was fairly good. Retail sales were quite solid. The jobs report was, solid with a question mark. National incomes are higher in January, meaning that consumers, households have more money to spend. However, you did see CPI and PCE data suggesting that, well, inflation can come back rather quickly. So that's the problem with that shore, which means you end up with, if we believe the Fed, higher rates for longer, or until something breaks. And it's usually the until something breaks. It's usually not higher rates for longer, then inflation goes away and then they bring rates down. That doesn't happen. That's called a soft landing, and well, the pathway for that just got more narrow. Usually something breaks. You get too close to this shore, you hit a recession. Leading economic indicators are already in recession territory, negative again, I think 8 months in a row. New orders are below 50, which is contraction on the diffusion index. And you have curve inversion, and again, the capital market to money market, which is the 10-year, 3-month, has a 100% track record. This also has a 100% track record when it is in not just inflation warning, but in inflation signal territory. This here is whenever you have a chart and it just extends out over time, you put one of these little things in saying that, over some time, you have a waterfall which doesn't end well. You crash on the rocks and the waterfall is falling towards the recession side. That is the something breaks, that it's inevitable at this point. It's just, you could hit one of these, if you hit the inflation shore, you're going to go higher for longer, which will push you back into the channel. You're eventually going to hit the recession side, and higher unemployment, inflation's only solution. Recessions have a 100% track record of getting rid of inflation. 100% track record. If you want to get rid of inflation, just cause a recession. Just break something. Just raise rates until you break something, and you will get rid of inflation, and then you can lower rates. But for inflation to simply just disappear is not going to happen when you have free choice in an economy, because if you give people more money in their wages, they have free choice. They'll go to the malls and they will spend it. 70% spend everything they make. So the only way that you can actually avoid inflation is if you increase the amount of forced savings. So you say, the government can say, okay, from here on in, we're going to take another 7% off of everybody's paycheck for Social Security. 7% forced savings is going to happen. Well, then they don't have that money to go to the malls. And there you could probably cause inflation to go away by simply removing free choice. But in an economy where you have free choice, if you give people money, they'll spend it. There is the problem. The only thing the central bank can do to make sure that people don't spend it is to make sure they don't get it. And that's higher unemployment. Now, there is a social argument that you can make that perhaps the central bank should not be concerned about inflation just yet. And the central bank's pushback to this is, whoa, 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 whoa. Once inflation expectations become embedded, it's over. It is brutally difficult to get rid of. That's the problem. So there is a benefit to higher inflation. There is a solid social benefit to higher inflation. And the only group of people that would get hurt is the investor class. If you take government debt, which I think is sitting around 34 trillion, 32 to 34 trillion, you add household debt. And we just saw in February 15th, the report for Q4 shows household debt sitting around 16 trillion. And then you add corporate debt. I'm not sure where this is sitting, but I think it's 15 to 20 billion. I think 15 to 20 trillion. I said billion. One company will issue that much. Trillion. There's somewhere around $70 trillion. And if you think about GDP, 24 to 25 trillion, you're almost close to about 300% debt to GDP. And if we think about nominal GDP, it's a little bit lower than that. We would think about it in terms of nominal GDP because the tax base is based on nominal GDP. So the ability to pay the debt is based on nominal GDP. The ability for households to pay their debt is based on nominal incomes, not real incomes. Same with corporations. So we would think about it in terms of nominal GDP. No need to deflate the GDP. Here's an interesting thought experiment. Double the price level in the economy, which means double the price of everything, double everybody's wages. What would happen to nominal GDP? It would double. What would happen to this 34 trillion in debt? It wouldn't move because debt does not inflate. It stays the same. So you'd go from 300% total debt to GDP to 150%. You inflate the debt away. Not only that, nominal GDP is twice as high. The tax revenue for the government is now twice as high without raising tax rates. You can whittle down that 34 trillion very nicely. Same with households. They can whittle away that 16 trillion very quick. That debt could be paid off very, very quickly, even though you would have a higher interest rate on the debt because your revenues would be increasing rapidly. You'd be able to pay it down because it is the one thing that would not inflate with everything else. Oh, sure, you've got twice the amount of money, but a coffee now costs twice as much, but your credit card bill doesn't. Your mortgage doesn't. Your auto loan doesn't. You get that? So you can inflate away the debt for a period of time, but the central bank will say, but that will get embedded in wages, and if it gets embedded in wages, game is over, which means we will have to live with a higher level of inflation, and that's it. And that's why they are so adamant about getting that out of there. And the only group of people who would be hurt are the investor class, and only during the adjustment. Because a market that trades between 18 and 20 times earnings is basically the same market that trades between 10 to 12 times earnings. In other words, if you exit the market at 18 to 20 and you go for a walk and you come back and the market is trading at 10 to 12, the opportunities are the same. They're the same opportunities. You're just buying stuff at a cheaper price, but you're buying more of that stuff that your return is going to be pretty much the same. What you don't want is to live through the market going from 18 to 20 down to 10 to 12. The adjustment would hurt. It would be a significant loss of wealth to the investor class during that period of adjustment. But once it's adjusted, trading at 10 to 12 times earnings, again, it's the same opportunities as trading at 18 to 20 times earnings. And there is already sort of a negative view towards the investor class anyways. I don't know if I've ever seen such a time where you almost have to hide your success because you don't want to be judged as evil simply because you did all the right things, that you sacrificed, you invested, you put in your time, you were successful. Now society thinks that you're evil. I don't know how we got to that point, but there we are. So there's a social argument for just leaving inflation where it is. The economic argument from the Fed would be you can't let it get embedded. Once it's embedded, it moves into expectations. Once it's in expectations, good luck getting rid of that without a really hard, serious recession. Down here, the argument for higher unemployment is a more efficient, resilient economy on which growth can be far more significant, that the future is better over here. And you do get inflation out of the picture over here, but you don't inflate away the debt, but you do keep a lower interest rate because interest rates would be lowered. So the debt servicing costs are significantly lower. Why do we say this leads to a better economy over here? Well, you'll get higher unemployment. But if we've got this structural problem, and I'll clear out some space over here, if we've got this structural problem with labor, that it is so upward, the curve is upward sloping, very steeply upward sloping. If you do manage to flatten that supply curve, once we get out of the recession, won't it just steepen again if we feel that there is your hard, there's 60, let's call it 63% participation rate, there is your hard structural limit at 63. Wouldn't it just steepen again and inflation would just show right back up again? The history of recessions and recoveries shows that if you can get unemployment up, companies then invest in a lot more efficiency at that point, which means in the next cycle, to produce the same amount of output, they need fewer employees. They become far more efficient at that time, and resources are released into the economy for other purposes, so that in the next cycle up, they are far more efficient and inflation doesn't show up at that speed. Here's an interesting thing that I took from my dissertation research, which sort of counters this argument a bit, is here's a Phillips curve. And this is, we'll call this unemployment and we'll call this inflation. Actually, it has to be the other way around because of the way I did it, inflation and unemployment. And there's your Phillips curve. And I had looked at patents through the period of 72 to I think 72 to 94. So long ago I can't remember. I took the top 100 patents by citation and a significant a significant piece of research that leads to a whole bunch of innovation. Usually flows from a very highly cited patent because of all the follow-on innovations that happen. And I sort of did a grid like this, and I plotted where those 100 happened. And it was so one-sided as to be absolutely clear that some of the most significant innovations in research are discovered in periods of low unemployment and high inflation in this zone right here. And it's not so much that it was low unemployment, high inflation. If you mapped it to the business cycle in terms of expansion and recession, they tend to happen in expansionary periods, which typically coincide with high inflation, low unemployment. Contrary to the popular belief is that the more significant stuff happens in recessions because companies regroup, they reorganize, and they say, okay, we need something here, like what do we have for the market that's ahead of us? But it doesn't. It happens over here. So that you are actually crushing the potential for innovation in this particular environment by forcing a recession to happen. So I guess the question is, well, why does it happen here as opposed to happen here? And for this, you got to go back to 1932. And an economist named John Hicks coined the phrase induced innovation. And what he saw was if you regulate an unregulated industry and that regulation raises costs in that industry, you will have a wave of innovation coming in to avoid the cost. So if you say to a company, you can no longer dump your chemicals in that river, then that company will invest in some technologies that makes the chemical inert, or that finds another way to dispose of that chemical. That innovation is now being induced. Well, higher costs for things will induce innovation. You got a labor cost problem. Here's some AI. Here's some robotics. Here's some automation. Here's some technology that can solve your labor problem. It induces innovation. It increases the pace of innovation. So we can make some really good technological reasons why we would want this regime to continue. You can make some good social reasons why you would want this regime to continue. The only group that really gets hurt is the investor class. So is it that bad? Do we really have to force a recession on what seems to be an otherwise vibrant economy that wants to go? You have consumers being paid that want to spend money. It is, I think, going to be a thankless job steering this ship, because a mistake is almost all but inevitable. Think about it if you had to do it. The mistake is almost all but inevitable. No matter what you do, you're going to make a mistake. And I think this is the inevitable outcome, is the recession. Let me know what you think. I mean, you could have a debate on this topic for hours and hours. It's super interesting, the different ways that you can go with the argument as to which environment seems to make has more check marks for it. The Fed's big argument up here, just so you know, the Fed's big argument here is the embeddedness. That once it becomes embedded, it becomes structural. It's no longer cyclical, something that you can fight. It becomes structural, and that changes the rules of the game in ways that we can't possibly anticipate. We don't even know if that would be good. But if we find out that it's not, it is going to be brutally, brutally difficult to fix without a very bad, very deep recession. And that is something they just don't want to see. Okay, let's have a look at SPY. If you have the applied series in the Market Outlook Extras folder for this week, I'll talk about Home Depot and Walmart's guidance for the next year. We'll look at an event in the office REIT space, another default. It came out in the office, or at least the details of another default have come out in the office REIT space. And private credit, there is an index, a default index that we can look at. It's released quarterly by a law firm. And we only get really the headline number. We don't get any of the detail behind it. For that, you have to subscribe, but at least we have something there. And then we'll look at materials, particularly the mining stocks, because they've pulled back quite a bit. So the question is, why have they pulled back, and what am I doing about it? For everyone else, we have SPY here. Forward four-quarter earnings now down to 219.71, was 220.16 last week, so it's down another 45 cents. Closing SPX 39.70.42, and if you come all the way to the far corner of the screen here, there is our forward earnings, 18.07. Still probably too high for where we're headed in terms of rates, in terms of the probability of recession. Comparing it to other yields, turn it into a yield 5.53, 6-month T-bill 5.06, 1 to 3 year investment grade 5.48. So the market itself is sitting 5 basis points above the 1 to 3 year. And we're looking at this in terms of distribution. The idea is that, you can probably get more than 5.53. The market has returned more than that over the long term. But that's the point, right? It is a distribution. If you look at a 6-month T-bill in terms of a distribution, it is a point estimate. That's all it is. The 1 to 3 year has a very tight distribution because it's going to have very low default rates. So you got a very tight distribution, whereas equities have a very wide distribution. So yeah, you could get more, but nature of distributions means you can also get less. Are you willing to accept a wider distribution of outcomes for 5 basis points? I'll give you 5 basis points more. However, you could really mess up. You could really do well, but you could really mess up. that is not enough compensation, I think, to accept that kind of dispersion in outcomes. June ES contract closed at 40.11. My average price now is 41.47 because I closed my 42.50 calls at 80. I had paid 111.75, and I had sold 50% of my position at the 40.50 puts and matched them with the 42.50 calls. But given the volatility we see in markets, we're up, we're down, we're up, we're down, we're up, we're down, I figured, why not take the money while it's there on the calls? It probably is going to be a rally next week anyways. I took them early. I watched these go all the way down to 55, which really bothered me because I left another 25 points. I grabbed the 30 points and left another 25 points on the table. A little upset about that, but it got my average to 41.47. My puts at 40.50, market's at 40.11. So if this stays under 40.50 until then, it will be put to me at 40.50, but I'm short. So it'll cover my short position at 40.50, which I got 122 for, and I get to keep 147 down to 150. So that's almost a little over 200 points. What is that? 97 on 122. 220, roughly 220 points on half my position, and I'll still have the other half. So not bad. If we get to a point where the market is above 39, what is it, 122, 39.28, somewhere between 39.28 and 40.50, that means these will have paid off to some degree. I will then roll them forward. I'll take the profit and roll them forward and add to my premium. Where are we sitting here on our close? The 50-day moving average is 396.83. We're just kissing the bottom side of the 50-day moving average. The 200-day moving average, 393.16. It did come down. It bounced off the 200-day, and then it found support there. So we did have a rally near the end of the day on the 200. So it did hold support. So there is something promising there in that sense. If it doesn't hold there, you have your December lows, which are between 3750 and 3800 on the index. It breaks that, you'd be going to the Novembers and then revisiting those October lows. This wick got all the way to 3500. You'd be revisiting that. If we think about a long-term equilibrium level for the market in terms of its the mean reverting level for the forward multiple, 16.6 is long-term forward average, puts you down around 3650 on the market. And if we assume that's equilibrium and we want to do some equilibrium pricing, let's say 11% as a long-term return, knowing that 2% of that roughly is the dividend, you can take that number multiplied by 9% and you can get a target price for the index for the end of the year of 39.87, or basically 4,000 would be a target price using the 16.6 equilibrium level multiplied by a long-term growth rate, which you could probably arrive at with a cap M, would put you at 4,000. And that's basically where we are. It's just, what's the pathway to get there? JP Morgan seems to think it's going to be a drop as much as 25% down to 3,000 by mid-year, and then a rise back to that level by the end of the year. The path is what can hurt you along the way, unless you just want to close your eyes. If you're not using any leverage, you could just close your eyes, go away, come back at the end of the year and go, nothing changed. This thing went flat all year long. Just don't look backwards, right? Implied volatility showing up here. Look at this, the 13-week IVP, 59%. Options are back on the menu, boys. Up from 31% with 59%. There is some premium in the options. Friday's put-call ratio, just Friday alone, 1.18. The open interest on put-call is 2. Hard to read anything into that because it was a Friday expiration. So you had a lot of options being closed, and if you had more puts than calls, well, it would change something. Versus 2.18, IV last 19.8. My thinking at this point is given where money market rates are right now, given where what you can get, and given where the multiple is, and the inverse of the multiple, the earnings yield 5.53, that you have to start to think, well, I can get a whole bunch of distribution in terms of my return, or I can get a very tight distribution on a 1 to 3 year investment grade, or a 6-month T-bill at 5.06. I could sit there for the next 6 months. One thing is clear, the central bank is going to continue to raise rates. That's never good for equities given the situation that we're in. That's going to put downward pressure on pricing. I think more and more at the margin, there are investors that are thinking it's probably safer just to move into a cash position. The level of the reverse repo sort of suggests that that's a crowded market to be in right now, because there just simply aren't enough securities at that end of the market. So the conversation that I've been hearing lately is, listen, you've got a 10-year pushing 4%. We're not going to stay at these levels for very long, which means if you go into the 6-month, yeah, you might roll it over at 5% again one more time, but how many more times can you roll it over at 5%? Wouldn't you rather lock in 4% for 10 years? So money is going to, I think, start supporting duration more. Well, if you're going to buy that, what are you going to sell? To buy something, you got to sell something. And I think that equities are going to be a source of funding for a while. I am probably going to increase my short position on this one on any rally. And when I increase my short position, my macro overlay, because I'm holding stocks. I do have housing stocks, I got mining stocks, I got equity REITs, I've got mortgage REITs. What else have I got in there that's interesting? I do have some auto companies still. I started selling puts on GM again when I saw it break under 39 into the 38s. If it gets down to 36, I will do the same thing on GM. I'm also interested in Stellantis, which has an interesting ticker, STLA, which is, you got TSLA, Tesla's last Stellantis. Beautiful operating margins. Slightly under what Tesla has, and sells significantly more vehicles and has significantly higher cash flows and revenues. I was surprised when I saw the results. It's like, whoa, look at you guys. Nice. In third place on the margins, GM, on their operating margins, not their gross margins now, their operating margins. So I think a portfolio of Stellantis and GM probably makes sense, so I'll be selling puts on that. So I have individual stocks. Most of what I have are typically low multiple, low price to book, so that if you do have a re-rating in the market downwards, they would suffer the least. And then I have my macro overlay, which is short beta, long duration, primarily using derivatives. If I add to my beta position, in other words, I sell more ES, or I open up and sell more calls. Again, on any rally, if I sell some calls, I will also add to my duration position because of that positive correlation right now, so that I have very low portfolio volatility. And if I'm right, I'll just have two big positions that then turn into a negative correlation and move in my favor. I just can't see a market rally with bonds dropping in price, because for bonds to drop, rates have to go higher, and if rates are going higher, I can't see a market rallying into rising rates. So I just don't see the negative correlation hurting me on both legs. That being said, the universe is listening, and the universe is saying, hold my beer, show this guy a thing or two. So that's where we are. Let's have a look at the week coming up. Earnings are primarily retail. So it is their guidance that's going to matter, which is why I'm picking on Home Depot and Walmart from last week, because they were retail as well. It is the guidance that I think will matter for whether or not we hold that 200-day moving average. Okay, here is our economic calendar for next week. Monday, durable goods. We've already mentioned pending home sales. February 28th, retail sales. There's the housing price index. You have PMI manufacturing. And the ISM number, the PMI, that's the S&P. You have ISM, construction spending, productivity, and costs. And PMI services on Friday. So not a lot of big market moving events. These are, well, I wouldn't say they're not unimportant. They're more secondary at this point. The big things we look at right now, the story on the street are jobs and inflation. Trying to figure out where the Fed is going to go. Let's look at earnings for the week. This is the 27th to the 3rd, and who we have reporting. Oxy, that'll be interesting to see. You have AutoZone, JM Smucker, you have Target in here. Where are all the other retailers? Dollar Tree, Lowe's, Best Buy, Kroger, Costco, Ross Stores. Heavy week for retail. I use Oxy as an income factory right now, so I'm interested to see what their earnings are going to look like and what their payouts are going to be in terms of dividends and share buybacks. But there you go. It's going to be a rather light week. It says 27 issues are reporting, but one of them is a Dow component. So that means 26 are S&P components. And if you were wondering on the sheet, many of you already know, but if you're wondering where you get the forward estimates, you click on the first tab, and they're small. Let me just increase this. If you look at row 92, column D, there it is right there. There's the current estimate for earnings. So this is C2023 expected 219.71, and if you scroll down, you have them broken down here by each of the quarters. And if you go into the sector EPS and you scroll across, you will find them listed in terms of, where's 2023? Here they are right there in terms of each of the sectors. And that is it for the week.